Looking forward today to our presentation for the Pension Committee, and I'm sure you'll have some good words of wisdom for us.
Happy to try. Thank you very much. All right. Good morning, everybody. Happy New Year. It's wonderful to be with you here on this sunny, brisk day in Syracuse. The stock market's off to a great start in 26, following a good year in 2025. I'll give you some broad comments before I jump into the reports. The stock markets were driven in 25 in the U.S., and to some degree internationally by good earnings growth. That's what drove the gains. But the gains were concentrated in the largest capitalization companies, the big growth companies that have driven the market for the last couple of years. But interestingly, towards the end of 2025, we saw investors get a little bit more selective about those particular companies. They've been spending, the NVIDIAs of the world, the AI companies doing the AI build out have been spending tremendous amount of capital. Capital expenditures have been extreme for these companies, and their free cash flow is declining. So there's been some concern in the investment world about whether this innovation is going to deliver durable earnings growth for these companies long term. And not the whole sector in general, but being more discerning about the companies themselves. So we've seen an interesting shift in market leadership. This year, and starting at the end of last year, small cap has now started to outperform. The number one performing asset class last year was international stocks, both developed and emerging. And that was not the conventional wisdom at the beginning of 2025. So that's something to think about from being a disciplined, diversified investor about that conventional wisdom. And we're sort of seeing the same thing with small cap. It's had a tough run for a couple years. We've talked about that in previous meetings, but it's up 2-1 over large cap this year. So the thinking, and maybe this is the words of wisdom Nick was looking for, market leadership changes are extremely difficult to forecast and forecast them accurately on an ensuing basis. And they often occur in areas that the sentiment is the lowest. Last year, international, maybe this year, small cap. So Alesco builds diversified portfolios for our clients, pension clients like Centro, so that our portfolios can transition and participate in these leadership changes when they happen after the fact, once the gains have started to materialize. So from our perspective, the lessons of I've just reinforced the discipline that we have around portfolio construction and how our clients can benefit from being diversified and being disciplined, which your committee has been, the pension committee, with this allocation, and being able to rebalance. Those are the keys really for long-term investment success. And last year's lessons just reinforced that. So as we jump to look at the reports, we'll start with the non-salaried plan and look at the allocation as the end of December. So we're on page 1, tab A. The equity allocation for the non-salaried plan was 66.6%, so 67%. Slightly, a point or so higher than our target of 65, but we had a good market at the end of the year and haven't had a chance to rebalance by the end of the year. The remaining 35% is in fixed income, the purple and blue, both fixed income, and the inflation-protected government securities, real return assets at 6.6. Everything is within the ranges of the investment policy and managed very close to target. The equity allocation, so that's 67% equity allocated as such on page 2, roughly 70-30 between domestic and international. The international we break off on out of the pie on the right-hand side of the page. That was your best performing asset class this year, 30+% returns out of that 30% of the international portfolio. It really contributed mightily to performance and sort of masked some of the weakness that we saw in the small cap space. Another benefit of being diversified from that perspective. Your largest holding was the large cap stocks. That's the 46% large blend, almost 47. That was the next best performing asset class. But those parts of the top of the pie, the large value, mid cap blend, small and small value, are what's outperforming at the beginning of this year. So that's the example of what I was talking about the transition through market cycles and being able to take advantage of these changes without very much disruption to the portfolio. International and small cap leading now. The last couple of years, large cap was the lead. We get a great portion of those gains without having to guess what's happening next. We're not making any changes in the equity allocation. We think, given the market cycle, the opportunity for a continued weaker U.S. dollar and international, as well as the potential for a few more interest rate cuts this year, we think the allocation is very appropriate for that cycle. International and small cap have a chance of doing well next year, or this year, I should say, and large cap is poised to also continue to do well, even if maybe not quite as well as it had been. We did make a change on the next page when we look at fixed income. You'll see a new piece of our portfolio called asset-backed at 10%. That had been a treasury bond fund that we held. We were looking at, and this is too bad Bob's not here to ask us questions about this today, but he could follow up with me if he needs to. We were looking at credit spreads. That's a technical term for kind of the risk in the bond market. Looking at the differences between treasuries and corporate bonds. Corporate bonds had a good year, but the difference between the yield and the risk profile of treasuries and corporates has gotten very tight. So historically tight. And what that means is you're not being compensated at a level of historic levels for the risk in the corporate bond market. So we wanted to reduce that exposure slightly, not dramatically, but slightly below where it is in the Barclays or the Bloomberg aggregate. So with the portfolio where we don't have any distinctive corporate bond exposure, we have to reduce our broad bond market exposure. That's that intermediate core bond you see there. It was 90%, now it's down to 80%. So that reduces the corporate bond exposure because it's in that bond fund. Roughly 30% treasuries, 30% corporates, and 30% mortgage-backed agency securities. So we've now reduced corporate bond exposure by about 5% to the broad bond market. We added this asset-backed security because it's higher quality. The yield is comparable to the corporate bonds, and the valuations are more attractive. And when you think about the potential for lower interest rates, mortgage-backed securities could also potentially benefit from lower interest rates this year and an improvement in the real estate sector. So overall, we've improved the quality of the bond portfolio. We have more AA bonds, and we've continued to keep the duration, which is the interest rate risk profile of the portfolio, the same, and the yield roughly the same at yields about 4.2, 4.3, and the duration is 6. So all those parameters the same, increased the quality, and sort of reduced our corporate bond risk in the portfolio. TIPS portfolio on page 4, keep that the same. Those have been a great diversifier, but maybe not quite as powerful if we don't continue to have the surprising levels of inflation, but it's still going to stay sticky, so we're not changing that. On page 5, we take a look at performance. So here's where you see what a really superior year 2025 was. The quarter to date is September to the end of December. You had a 2.39%, 2.4% return, $1 million gain during that period, and the value of the non-salaried plan was 43.5 at the end of December. I talked about January being good, so we're a couple weeks into January. As of the close yesterday, the pension portfolio for the non-salary plan was up 2%, an additional $873,000. You're at $44.5 million. So the market continues to climb a wall of worry, and the earnings growth looks good for this year. There's expectations that GDP might even be higher. Consumers keep spending, and while the job market is not as strong as it was, it's not particularly weak either in terms of layoffs. So lots of positives there, and when we look at that performance. The one-year returns, 15%, $5.8 million. And then longer term, we've got compounded returns, not compounded, of 13.65%, $14.7 million at 3 years. 5 years, you're at 7.5. You're 8.8% back to inception in January of 2020, almost a $19 million gain. And just with that 2% gain this month, your inception returns are now 9%. So those are materially above the 7% annualized rate of, or your 7% return expectation for the portfolio that the actuaries require. So that's been very good. Should be positive for your funded status of the plan as well. Couple things that I want to highlight on page 6, just to look at really the transition in leadership, kind of give you a deep dive into how that looks. Let's focus on the 1-year return really, and we'll see the numbers there pretty highlighted pretty well. Your equity returns are across the top in gray. Those are the rolled up performance of all the underlying funds to give you that asset class performance. 19.8% return for equities last year, so just about 20%. You can see your large cap return for the S&P 500 was 17.8. Certainly not a shabby return for large cap stocks, but the portfolio did better than the S&P 500 last year. That's not a goal that we have necessarily, but it's a function of how the inflation played out at international return. 33% out of those asset classes, and that's some of your second largest holdings in the portfolio at 30% combined. That masked the weaker returns out of small cap that we saw last year, 6 and 7% out of mid and small cap. It was a tough year for those types of companies because financing costs remained high. There was expectation for rate cuts that didn't materialize in the same way, so they're somewhat unloved. But that's kind of the point of where the point of international stocks were last year. Very unloved, no expectation, and just a little bit of better news gives you quite a bit of a pop in the return, and that's what we're seeing this year. Small cap stocks through the close yesterday are up 8%, and the S&P 500 is only up 0.5%. So and international is up not as much as small cap, but 2 and 5% roughly. So those trends that were starting to take place at the end of the year are continuing. Of course, I have no idea if this is going to continue through the rest of the year, but it seems like there's a good chance that it could. And if you just follow across the top, you've got very strong equity returns back to inception. Given everything that the capital markets threw at the world, or the world events threw at the capital markets, I should say, over the last 5 years, to have an annualized return of almost 12% back to inception is very good equity returns. So it's the idea of being disciplined, sticking with an allocation. And, investors could have panicked, and many did, at several different points in time there. But yet, you stick with the allocation, stick with the market, rebalance when you need to, and you can capture some pretty significant equity returns. The one thing I want to focus on, if we follow down the column again on that page, looking at fixed income, and taking a look at the 1-year return for fixed income, 6.87%. A little bit behind the Bloomberg Ag, but that was that Treasury bond fund that we had that kind of pulled back some of the performance based on that. But you look at that return and compare it to where we were 5 years ago. We're on the other side of a period of the market that was a bond market that was focused on interest rate increases and the impact of that. When bond yields go up, the prices go down. So it's a tough period for bonds. And you see that in the 5-year returns. We're over that hump. Bonds are now providing the stability to a portfolio as we've normalized interest rates and contributing meaningfully to total return. You wouldn't have gotten that 15% total return in the portfolio if you didn't have such significant fixed income returns at 6.8, and that's a function of yields being higher than they were 5 years ago. So it was painful to go through that, but we're on the other side of it and we benefit from it. Sure.
What do the interest rate mean?
So we're like it for the Fed funds rate. We're somewhere in the range of like 3.5. I think is a roughly 3.25 is where we are now. So just over 3% for the Fed funds rate. And there's an expectation of a few more rate cuts this year, but again, that's data dependent. What inflation rate's dealing with. The Fed's got a conundrum right now in terms of rates. The job market has been weaker, but inflation has been sticky. So they've got a dual mandate to work towards full employment and stable prices. So they've shifted their risk forecast to the job market. And so that's why they've said they've lowered rates the next couple of times. We also have sort of the political overtones of who's going to be the next Fed governor and how the mix of that comes in. So we'll have to see how all that plays out. But the market is expecting that the future Fed later this year is going to be more dovish towards rates. So and that's certainly not necessarily a bad thing. But there are arguments whether the economy is stimulative or not now, and we'll have to see that play out. But the market expectations are that there will be a few more rate cuts this year. The last thing to look at, again, we always look at this, is on page 7, just how does the pension plan performance compare to other managers? OCIO is outsourced chief investment officer data. We compare the Centro portfolios to other DB plans and an asset allocation that is similar to yours at between 50 and 69%. You're at 65. And you look at your performance across the board in all these time frames for the non-salaried DB plan, and you're right in line with many of these and ahead of your asset allocation index and better than the DB plan index. Some of that DB plan performance might be, we don't look at asset allocation there, they don't give us that granularity. So there could be some funds there that have, and probably are, maybe they are closed funds, or they've been, they're not accruing new benefits, and so they have an asset liability structure and their asset allocation is lower than yours. So that could be the difference there. So the most appropriate comparison is that moderate fund, and you can see you've done very well against that. So good against the benchmarks, also positive versus other managers. The next two funds I will go through quickly because, as you know, they're all allocated the same holdings, and the performance is going to be the same. 66% equity for the salaried DB plan, same as the non-salary. Next page, we take a look at the equity allocation, similar, 70-30. We didn't make any changes there. And for fixed income, the allocation, we've added the asset-backed fund to this. So the same trade happened in the salary plan as it did in the non-salary. Same parameters there. Our TIPS portfolio on page 13, 65-35 as well. Look at your performance for the salary plan. It's going to be almost identical. 15% for the year. Returns, gains of 5.7 million, 42.9 for the salary plan at the end of the year. And that long-term return better than the actuarial rate of return of 7%. You don't need to look at page 15. The same thing is going on there. International best performing asset class for the year, and practically a 20% equity return on page 15. You look at the comparisons for the OCIO data, you see that too as well. Very positive comparison for the salary plan because it's allocated in the same way, but very positive returns there for that data in comparison to the other managers. If we jump to page tab C, page 19, take a look at the Utica plan real quick. Utica plan also has a 65% equity, right in the middle of the IPS range, so everything for the plan is in line with the investment policy ranges and right on target. 65% equity allocation has that 70-30 mix between domestic and international. No changes to this fund as well. And on the asset-backed side, for fixed income, we added that as well into the Utica plan. So consistent across all plans, managed and allocation. TIPS, 65-35 as well, 64-36. And then performance on page 23, 14.79%, just under 15 for the year. But still long-term returns. This portfolio ended at just over 14 million, a gain of 1.8 million. So very positive there. And again, that long-term rate of return above the 7% actuarial rate of return. So you can also see the performance for the same for the indexes on page 24, and then your OCIO performance data as well.
Seems to be a good year, and Chris or Melissa, it seems to be well, we're in a good position here. Yeah. Good for the employees.
Absolutely. So I can hit a couple slides in the capital markets review, or depending on the time you need for your meeting, whatever you think. Okay.
We'll listen to you.
I'll give a few more, give a slide. So I'm gonna jump around here a little bit, because you can read through and see things. I've covered a lot of this data, but I want to highlight a few things just to sort of reinforce Nick's idea that I can impart wisdom on you here for the day. I like that. I'm going to take advantage of that. So if we could jump ahead to page 38, and then we're going to come back to a couple other pages. I just want to highlight this page because it shows how important it is to be disciplined as an investor. Intra-year stock market declines. Look at all those red dots and the negative returns at the bottom of the page or below the line. That's how far in any given year, at one point in time, the stock market, and we're defining the stock market here pretty broad-based as the S&P 500. So large cap stocks, a lot of the major markets, how much it decline at any one given point in the year. And so not every year, but you get some pretty significant declines. If we're all the way on the right-hand side, the market was down 19%. That was in April during the tariff tantrum in April. The year before it was down 8%, 10% before that. But those 3 years, you look at the returns, the market ended up 24% in 23, 23% in 24, and up 16% in 25. So what that tells you is that ignore some of the noise that happens on an ongoing basis, and take advantage of those downturns to rebalance when you can. Buy stocks when they give you an opportunity. What do they say? Make lemonade when you have lemons. So that's the idea there. And it's not uncommon for the market to decline 10 to 15% in any given year. That's not a reason to panic. View it as an opportunity. And in general, the market will move higher. Now, of course, it doesn't always do that. And you can see that. A couple years ago, during COVID, we ended up down 19%. But then the next couple of years are good. So there will be bad years, but it doesn't mean that every downturn is an opportunity or a reason to panic. So that's the first thing to highlight. Let's jump back to page 29, if you will. And that's going to give us a little bit of a sense. The next, global equity market, right. Global equity market performance here. This is going to give you a sense of the international markets for the year. The previous page. That's 30. 29. Thank you. This is going to give you a sense of the international returns for 2029 and where those returns came from. And this is important because the return parameters for the different market segments were different. We're looking at U.S., developed international, and emerging. If you look at the U.S. market, all these markets, it was great returns. The U.S., again, the Russell 3000, about 17%, driven by strong earnings by the companies in the Russell 3000. That's the green part. A little bit about valuation exposure and a little bit of dividends, but it was mostly strong earnings growth. When we go to the international markets, developed and international, the building blocks of those returns were different. It was more of a valuation driven, so the expectation of better performance coming out of those emerging and developed markets, plus the currency, the weaker US dollar, delivered that. It wasn't so much earnings growth in the developed markets, more so in emerging. So what we're seeing is the changing expectations for the market for international returns playing out in concert with the weaker US dollar. Those parameters are still in place for that kind of performance this year, as well as strong earnings growth. So that's something interesting to look at. If we could jump to page 31, I'm going to keep jumping around here. I'm going to look at page 31. So this is kind of the concept of this idea of investors looking more selectively at large cap stocks. And so what you see here is the growth of the internet market and the AI index over the last couple years. So this is an index that's put together by Morgan Stanley in purple, and it has outperformed the global stock market going back a couple years. These are all the companies that are in the AI build-out: computing capacity, cloud infrastructure, power generation, etc. So it's been a great place to be. But I mentioned that spending difference. So the hyperscalers are spending a huge amount of money on research and development and capital expenditures. That's the chart you see at the bottom of the page. So capital expenditures are exploding. Their free cash flow is declining. So we're getting down to zero. So these companies don't have a lot of money left based on their revenue to spend on this. So what's going to happen next is either they stop spending on the capital or they start going into debt to do that. So that's why investors are getting more selective. How are these companies going to continue to grow earnings, and which companies are going to be able to do it or not? It's not going to be a one-for-all move anymore, and we're going to look more selective of these companies. And so that's partly why the S&P performance might be slowing down now compared to what it was. So that's something to think about when we look at how the portfolio is allocated. And that's the last chart I want to look at on page 30. If we look at page 30. I've showed this to you on regular occasions to look at valuations. Valuations are certainly not a near-term way to think about what's going to happen next in the stock market, but for a future opportunity, they are valuable to look at. So you want to look at price to earnings ratios and where asset classes are on an ongoing basis. We've got three areas of the market to look at: U.S. on the left, international in the middle, and emerging markets on the right. And we also look at each one of these markets both from size and style: value, growth, large cap, and small cap. If we just focus on the large cap market, that's the S&P 500 for this exercise on the left-hand side of the page, your forward price to earnings ratio is what the bar is. The black line is the median over that time frame. And look where the market is in December of 25 and last year. It's all the way up at the top of the forward price to earnings ratio. So that means the large cap part of the market is pretty expensive and it's well above the median. Everything is priced for perfection in large cap stocks. If you go to the next line over, bar over, and that's small cap, that's what's had a very tough time period the last couple of years. It's priced for failure. So any little bit of better news is going to drive better returns out of that. That's this same idea of what happened with international. It's at the median, at the bottom of the range. Value stocks have done a little bit better, but they're still got room to grow. Growth stocks, again, like the large cap part of the market, very expensive and at the high end. So this informs how we want to invest in the U.S., why we have the small cap and value exposure, and we're not all in on large cap stocks. International markets are structured roughly the same way. The broad market is more reasonably priced, so that's your EFA index and emerging markets, more reasonably priced than the U.S., hence why their performance might have been better last year. And the same thing, small cap and value look much more attractive in those markets as well. So that's how we have our portfolio structured. That was some of the hindrances in the portfolio over the last 2 or 3 years, but we think the market cycle is certainly set for those to provide diversification and benefit the portfolio performance going forward.
International was stagnant for a number of years. Stagnant.
Oh, absolutely. I mean, you could say 10 years. I mean, it's kind of go all the way back. I mean, there's been a few fits and starts, but back to the financial crisis. And it's in part because the dollar has been so strong. The dollar weakness that we've seen this last year contributed to that gain this year. And there's not a sign that the dollar is strengthening this year either. So that could certainly benefit it. And you look at long cycles, they sort of run, these dollar weakness and strength run in 10-year cycles. That's a made up metric, but it kind of looks like that over time. When you look back at the 70s and the 80s, different periods were weak or strong. And when the dollar was weak, international did better.
Thank you. It was a very nice report. Any of the board members have any questions?
How long is the EI in the market? How much is the EI?
Oh, you see that chart. If we go, what's the page number? I think it was 31. I'll go back to that one. That may not be the right one. Let me see. Yeah, page 31. I mean, that just tells you. When you look at the global stock market, this is the chart at the top right-hand, well, it's not up anymore, but everyone that has the page, the top right-hand side of the page, you're looking at the MSCI All-Country Index. That's the green line at the bottom. And then the AI index is not just large cap stocks, but it's any company that has exposure and business in the AI space. It's outperformed, you got a return of somewhere 40% plus over this time frame from back to December of 24, so the last 2 years, versus a return that's a little bit over flat for the overall market. So quite a bit stronger for that, but that's also driven up valuations. And then we have this concern about the spending and whether the earnings are durable in these companies.
Very good. Any other questions? Thank you for the report. Thank you for the good news, and thanks for the wisdom.
Well, I'm glad somebody thinks I'm wise.
Yeah, we're gonna-
My wife certainly doesn't.
We're gonna go right into the audit and
I
find
just
it.
might need a moment, I
Yeah.
don't think this came.
Okay, yeah, we're good.
I sent Kate a message that
I would
was
say
just
thank you.
finished.
All right, thank you very much. All right.
Welcome to the audit and finance today. We're gonna start out with Melissa's third quarter financial statements. Good morning, Melissa.
Good morning, Mr. Chairman, members of the board. We're going to start off with the statement of net position. As of December 31st, the quick ratio is 9.41, which is quite a big improvement from last December of 7.92. Current assets total $63.7 million, reflecting a $5 million increase. And liabilities are $5.9 million, which is reflecting a $323,000 decrease. Cash and cash equivalents equals $45.7 million, which is representing an $8.9 million increase. What's driving this increase is our receivables are down. So the receivables we saw last December, primarily due to the bus purchase, we're not seeing this year. We don't have as many capital purchases as we did last year at this time. So that feeds into receivables being down. which we went over. Materials and supplies total $3.5 million, representing a small decrease of $284,000 compared to last December, and that's really managing our parts inventory efficiently. Prepaid expenses and other current assets are $4.6 million, and this is the same as we've reported in last quarters, where we do an adjustment to our IPNR at year end. Excuse me, no, I didn't say that right. Prepaids is due to the workers' comp collateral program that we got cash at the end of last year. Any questions on our assets? They're in a good standing. Accounts payables total $2 million, reflecting a small decrease from December last year. We are paying all of our bills timely, and that is an improvement from last quarter too, where through the summer we were a little short-staffed. We were back to fully staffed, and things are going out efficiently. Current liabilities are right in line with last year, and estimated claims payables total $1.1 million, reflecting an increase of $274,000. And this is due to the IBNR adjustment at year end. Any questions on the liabilities? Moving into our statements of revenues and expenditures. After 9 months ending December 31st, the authority reports a consolidated operating income of just $3.7 million, and that's excluding capital contributions and non-operating expenses. Operating revenues are performing at 6.6% over budget, 9.8% over prior year, and 17% over fiscal year 24. So the same news story as in prior months. At this point in the year, the conversation kind of gets boring because the story is the same. Ridership is right at 5% for that regular line ridership. Special line revenues are favorable, and that's due to our contracted revenues and advertising and other. It's right in line with budget in prior year. Any questions on our revenues? Operating expenses total $69.1 million, representing a $5.2 million increase compared to prior year. But we're performing 9.3%. Personnel expenses are $48.3 million and are performing $6.3 million under budget. This again, state every month, we budget these expenses being fully staffed throughout the full in the entirety of the year. We are still looking for operators. Non-personnel expenses are $21.5 million, $703,000 under budget, and $3.6 million over prior year. And the big driver continues to be that risk management line, and that is claims from a prior year. Any questions in regards to expenses? So overall, we are 9.3% under budget, 8.2% over prior year, and 16.4% over fiscal year 24 for expenses. Non-operating revenues are 4% under budget, 2.5% over prior year, and 11% over fiscal year 2024. And the big news story is that mortgage recording tax is continuing to perform favorably. Any questions on our non-operating revenues? Supplemental reports. So again, mortgage recording tax, that's 34.9% over budget, 31.3% over prior year, and 40% over fiscal year 2024. So we are right in line with 2022, which is one of our highest years of mortgage recording tax. In regards to our investment report, unrestricted operating cash totals $11 million. Board designated funds that are not invested currently are 1.2 million, with a total uninvested cash of 12.3 million. Our current investments total 15.1 million in operating funds and 17.8 million in board designated funds, with all of our interest rates below 4%, between 3.5 and 7.5%. Any questions? Our cash flow statement, operating cash receipts during December, we received 1.9 million. We utilized 7.7 million for operating, and 3 million of board designated funds were transferred to be invested. Any questions? If there's no questions, then that concludes this part of the report.
No more questions? Pretty status quo at this point.
Yeah.
Okay, so, we're gonna get into, we need a motion, I'm sorry. We're making a motion to accept the financial statements. Tina, second, Diane, any discussion? All in favor? Thank you. Okay, Chris, we're gonna talk about the Clever Devices hardware infrastructure upgrade index resolution 38.
Thank you, Mr. Chairman. Good morning, everyone. This resolution is for the purchase of hardware needed for our Clever Devices infrastructure upgrade. Before I get into this, I'd like to preface this by saying that this procurement was conducted using an RFP, or request for quote. Up to this point, you're familiar with us using terms of IFPs, invitation for bids, and RFPs, request for proposals. The RFQ was formally introduced into our procurement manual in the summer of 2024. That was approved by the board at that time. And we have been since using this procurement method with much success. The only difference at this point is that this is the first RFQ to reach or exceed $100,000, which is why it needs board approval. Just as a reminder, an RFQ can be used for any federally funded procurement that falls under the simplified acquisition threshold established in the Code of Federal Regulations. Currently, that cap is set at $250,000. The key difference with this procurement versus an IFP or an RFP is that it does not need to be publicly advertised. Instead, we send this out to a group of qualified vendors instead of publicly advertising that. So this particular purchase will be paid for with grant funds using an 80-10-10 split between federal, state, and local share. The request for quote was sent on December 9th. 3 vendors were invited and 3 quotes were received on January 5th, with the lowest responsible quoter being Lion Micro. That quote was received in the amount of $165,821. Therefore, it is our recommendation that the board authorize the issuance of a purchase order to Lion Micro for the hardware needed for this infrastructure upgrade.
Can you tell us what the Clever Devices covers?
It's the back-end infrastructure for, the technology that's on the buses, It's made up
GPS
of,
tracking, radio communications, it encompasses all of that.
Does it do the app?
It connects to the app, so the data does connect to the app based on the tracking on the bus. The app is controlled by a different vendor, but the API connects.
Okay. I think it's related, but I think with the bus network redesign, BRT coming online, I think it's time for us to look at the app critically. What we're putting out to the public, basically what vendor we're using. I think the landscape has changed. There's a lot of options out there. I want to make sure we're evaluating appropriately and making sure we got the best one with the best price and the best services for our community. So I just thought this was a good time.
Well said.
No real concerns with Clever Devices. Clever Devices, I think pretty much everybody uses. I don't know if you have an option.
Seems to be that way.
Okay.
Is this for fixed route buses only?
Yes, Clever Devices on our fixed route buses. The VIA application is what's using for our on-demand and call bus service now.
So Clever Devices wouldn't be linked to the VIA app and only to Go Centro, the other app?
Correct. Josh, I'm looking at you, yes,
This is like the real-time signage and a lot of other things
Yep.
too, like
Yep.
all kind of based off.
Yeah, it pulls from what Clever, so it comes in through Clever, and then through the API is disseminated to the interface on the other side, which is the app, which is through a different vendor, or Clever's information does hit the real time, which goes to the real-time signage and stuff like that.
Gotcha.
And then you should be able to link your, in your VIA app, you can link your, like website or your GPS into their VIA app too. They can integrate it. What grant is using to fund? What is the grant?
It's a great question. Melissa, do you know that off the top of your head?
I do not know it off the top of my head, but I can get back to you.
Okay.
It's a federal grant, it's or normal, it's annually allocated, not competitive.
Okay, thank you.
Any other questions? I thought the spread was kind of, interesting. 315 to 165.
Yes.
I can answer that, Mr. Chairman.
Yeah. Thanks, Chris.
So basically, HP is the manufacturer of the equipment. They work through what we call VARs, value-added resellers. Us, as we're going to those VARs saying, hey, we want X, Y, or Z, it's sort of, I'll say, a project. They can go to the vendor, the manufacturer at that point, and register as working on a project. And at that point, they get preferred pricing. So if it still goes out to the street,
Gotcha.
they get the preferred pricing, and, sometimes it's quite a swing. Other times it could be just a little bit, so.
Good job, team.
That's good, bro.
And I will say, we did, myself and Bruce had a conversation with our HP rep, this is the equipment, to go over the quotes that we received. I mean, it's the same hardware, the same quantities and everything, so he reassured us that it really is,
Excellent.
everything is the same that they're providing here in these quotes.
I have one final question. How were these three vendors selected to receive the request for quote?
Sure, so we just look at our vendor listing. We send to some vendors that are certified, some vendors that we haven't used, other vendors that we have good success with. So it just, in our procurement department, we scour our vendor listing and send it to a few that we just think that would give us good pricing on that based on some other quotes that we've received. Again, there is no MWBE goal on this, but Comp City is an MBE, so we still try to get that utilization. Otherwise, even if there is no goal on that contract, so that comes into play as well.
Any other questions? Okay, good job on my motion. Neil, second, Julius, any discussion? All in favor? Aye. Opposed, anything?
Yep, I'll just your report.
All right, let's take a few minutes and we'll get going about 10:05.
allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, we have a quorum as present. Our next meeting is February 27th. We'll have a legal committee, audit and finance, board meeting will be at 10. May I have a motion to approve the regular minutes of December 19th? Tina, second. Darlene, any discussion? All in favor? Aye. Okay, we're gonna go right into, Chris.
Thank you, Mr. Chairman. Good morning, everybody. Happy New Year. Busy month. Certainly a few highlights in my report. We've talked about some of these things already that were going on. Congressman Mannion, we did talk about the $9.2 million he did at the press conference here. To just highlight that, we certainly thank him for his partnership, but all of our federal partners for their support and partnership to continue to help fund these projects as we have them come online in the next 2 years, 27, 28. January 7th did an update to the staff, State of Centro, just highlighting what's going on in the authority, how 2025 came to a close. A lot of accomplishments that we've put together there. Certainly talked about some exciting things we have in line for 2026. And also touched that we do have a deficit coming on board, and we have plans in motion to tackle that. So all in all, good conversation. Certainly sharing my vision and the vision of the authority as we move forward with things to continue to build our reputation in the community, be at the forefront of people's minds as major projects come online like Micron and other investments in the community. We want to make sure we're part of that, and we're hitting the ground running pretty hard on doing that. As you look at the rest of my report, meeting with County Legislator Block, the mayor of Utica, Nick and I met with the mayor there to just talk about the service. He's new to office last year. We weren't able to connect with him last year, but we've done a few projects with him in the last year for things going on at the harbor in Utica, the city of Utica, that they're revitalizing that area, tying it to the canal celebration. So very good conversation with that. Continuing the roadshow with the system redesign and bus rapid transit meetings. Meeting with several folks and key players, OCMBOCES, OCC, St. Joe's, Center State, Crouse Hospital. Those conversations are going well. A lot of it is just helping them understand what the new service would look like, what on-demand actually means as it comes online, and how it would impact either their district or their business. But it also is a good segue into the conversation of some new revenue generators that we're working on with the Business Class program, similar to what we're doing with the city of Syracuse right now. So good conversations happening and a lot of positive coming out of that. A few things that happened since the writing of my report. The executive budget has been released. The state of the state was last week, and then this Tuesday, the governor had issued her budget. So we are going to see a current proposal in the executive budget of a 5.75% STOA increase, which is a fantastic start. Last year, she came to the table with a 3.4% STOA increase in her executive budget, and through the negotiations in the final budget, we got 4.88%. So starting out of the gate with 5.75 is good, but we still have work to do across the state with all our partners through NIFTA and as an agency to certainly continue to get that increased. Our goal is 15%, and we're going to continue to push that for across the state.
Chris, is the proposal to have free buses in New York City going to affect our
Not that I'm
funding?
aware of, no.
Good. I've been reading a lot about that, and people are like, well, does that mean she's gonna make them free in the whole state?
Yeah, no, that was she didn't address that in the State of the State or in the
Well, it's
budget
been
that we've seen.
It's been in the news,
Yeah.
like the past 3 days,
Yeah,
a lot.
I don't recall seeing it. Our NIFTA team is still rummaging
Figuring
through
it out.
everything to make sure there's nothing we missed. But we had a quick meeting to really get the highlights where the capital and the operating money comes in. So if something comes out of it or we see more, and then certainly we know we have the House and the Senate that got to come together to finalize the final budget. So who knows what could happen from there. So building off the executive budget, we met with Assemblymember Gallahan yesterday. We gave him a tour here of the facility, but talked about our ask, and certainly he is a new representative. This is the first time we met with him. He represents the Cortland area out to Seneca Falls, Geneva area. So it was a great conversation. Steve, Bren, myself, Melissa met with him. to talk about what we've done in Cortland, certainly the funding that we're looking for. We are looking for an additional funding source for Cortland right now to increase funding for what we've done in that area, bringing ADA paratransit that they have not had. And we're seeing ridership increases there. We're seeing more consistent ridership along our fixed routes because we're covering and the service is dependable. We're bringing on the technologies, the fare boxes, the Clever Devices program. That comes with a cost. And when we originally took over Cortland, we only got the $740,000 that Cortland County was receiving. We never got anything additional for that. So we're still pushing for that. We're asking for an additional $3 million for Cortland County, which will cover the current year. We're 9 months into the current year. That's about $1.5 million. So we're trying to recoup the funds we've spent now, and then looking for the $1.5 million to stay in the budget for future. It was well received, so we're hopeful to continue to see that. And as this happens across the state, we know the state has to come forward doing something. Rochester's right now working with Yates County to do something very similar to what we did in Cortland. Last Friday, I was at the Micron groundbreaking at the NVRC, the National Veteran Resource Center up at SU. Great event, certainly to see the excitement finally coming online and work beginning in the White Pines district north of the county, or in another. Certainly we know there's a lot of skepticism on the project and where it goes, so it's good to see activity finally hitting. We're excited to be part of that and continue to see what we can do to support that as things come online, construction starts happening, and population growth. A few things on the community side, the Roller Express that we talked about through the holiday season. We concluded that last week. That project provided somewhere over 300 individuals in the community an opportunity to visit Lights on the Lake that would have no other means to doing so. I met with the YMCA CEO, Josh, at the Micron piece. We talked briefly on it. They are excited about the program and how it performed, and they're certainly looking to next year to see how we continue the program and potential expansion if possible. So we're excited about that. The 81 South accident, I just want to highlight the operations team, the drivers, the team that comes together as we continue to do things in the community. If you recall last week on Thursday, there was the 34 car pileup down towards Lafayette Tully area. Cold weather, the snow, we understand what happened in the environment there, but our operations team received a call from 911 to see if we could dispatch a bus down there for the folks involved to keep them warm, transport them to a safe location off the highway. Certainly the operations team with a driver from ATU 580 jumped into action. We got a bus down there, and actually we got recognition nationally on this. The bus was featured on David Muir with the accident. The Tully Fire Department, DOT, reached out to us directly either through Facebook or to me directly to say thank you for the quick action and the opportunities of what we do. And to me, that's just another opportunity of being proud to support the community for what we do on a regular basis. In a time of need, we step up. I'm coining the phrase, we are second responders, and using that as something to be proud of. We're not running in the fires, but we're there to support the fire department. We're there to support the individuals, the troopers, DOT. And that's just something we do above and beyond what we do on a regular basis. So thank you to everybody for that, and the team, and certainly our unions folks for stepping in to do that in a time of need, that they were ready and available to do that. In closing out my report, I just wanted to recognize Chairman Lano and Darlene, Secretary Darlene, for their 20 years of service on the board. Both of them came on within a few weeks of each other in November of 2005. So in theme with the RPM recognition, which will actually start next week, they last quarter met their 20 years, so we wanted to recognize them for that this month rather than waiting till next month.
Darlene, any comment?
Yeah, I've learned a lot. It's been a great experience. I've met wonderful people. And I love working with Nick.
Yeah, it's been great. It's been great. And I can still remember the first day I met Darlene in this room. So I don't know where 20 years have went, folks, but it's
I know it. Nick had little preschoolers.
Right.
And now they're all adults.
Yeah. It's been great. It's been a wonderful thing to help serve the communities with public transportation and work with great people that are around the table and in the audience over here.
If there's any questions, go ahead, Julius.
Yeah, congratulations to you on that. Oh, this is to you. Before I ask you a question, My wife and I celebrate our 56-year anniversary.
Wow.
Congratulations.
56
And
years.
50 years, and I wonder how she put over me all this. The question, Chris, I want to ask, since we are such neighbor with GMA, and they are in this process of expanding, have you been in contact with them?
We have been in contact with them. I have a good communication with Gail over there. We have a long history of family friends, but if we do communicate with them, mostly if we do, it's probably through Jackie's team, through security, if they need access to the parking lot across the street, or if we can help them with anything. But nothing major at this point as far as what they have going on. I know, I think in the spring they're looking to start their construction work for the expansion. But any other questions on my report? Keeping in time, I know we have some timeline things to keep up, so Josh is gonna come up and do the quarterly reports. You guys.
Today, the board has, I know they're anxiously waiting for it, some training today after the board meeting, so I'm gonna keep whipping them. Let's go here, come on.
All right, thank you, Chris. Good morning, Mr. Chairman and members of the board. December ended, marked the end of the third quarter for Follow Us Statistics. We continue to see a 10% increase over prior year. That seems to be a trend that's going. Just a couple things I did want to note. You will see an increase in cancellations and no-shows for this quarter. That directly relates to the weather. One day in particular, December 30th, we started the day with about 900 trips. By the end of the day, we only had 297. That was the very snowy day. That's been, we typically get cancels, but that was obviously not the ordinary day. So the weather has caused more cancels in November and December than usual. So that's why there's that peak. With cancels typically come higher no-shows as well. So that really accounted for all of that. But the one thing to note as well is even with all those cancels, we still had a 10% increase. It probably would have been higher after we had better weather. But it is something that we continue to see, that rise in ridership year over year. So other than that, not too much to note on there. We did have our quarterly ATAC meeting on Tuesday. We talked about the system redesign, answered any questions they had, and wrote down their feedback for future improvements. Other than that, and ATAC, just so everyone knows, is our Accessible Transportation Advisory Council. Anybody have any questions?
Josh, are we getting closer to getting more drivers on the road that work for Central? I'm gonna throw you under the bus.
We're gaining momentum. We just had the last driver class turn in just before the end of the year, before the holidays. So we're at 168 roughly. So we're getting closer. We have a class that they're putting together right now that'll I think it's about 15, and I think they're still doing interviews as we speak. So and that's just for Syracuse.
Yeah.
So we're gaining momentum to get back to our full allotment of right around 184 operators for Syracuse full time. So as we continue to come online with that.
I've called you from the bus with a few snafu
Yeah.
things, and I think if we had more vehicles on the road, we wouldn't be stuck in spots where you got 3 giant wheelchairs and you can't get them on the bus.
So if you, I don't know the exact number off the top of my head, but we are seeing an increase of number of trips performed on our side versus the vendor side. So the vendor side came down about 1%, I want to say, for the month of December. So we are pushing a little more to our drivers. So
That is good, because two things, our buses tend to hold more chairs, can accommodate bigger chairs easier, and our drivers, I would say 99.9% of the Central drivers are really good at what they do.
Mhm.
Some of our vendors are not so.
and we're taking advantage of the downtime of Syracuse University and the school district. So
Yeah.
when those are down for the breaks,
Yeah,
we have more drivers available. So we've been pushing some work to our drivers in-house what we call extras
Yeah.
to make up for that. So that is something we are doing to increase our presence out there.
Because that's people go, you're on the board, how come there aren't more central call buses? They said, I ask all the time.
Yeah, a lot of it comes down to manpower,
Yeah,
Yeah.
that's
Yeah,
what I
we
tell
can-
them, no drivers.
right? And it's, we have the opportunity on the subcontracting side for the call bus rather than fixed route, of course.
But I think they are doing a good job at what they have. I
They are.
really do.
Yeah,
And I really applaud them. But whatever they have, they're really doing a good job.
Oh, never take what I say and say, they're not doing an awesome job, because I always know if something is out of whack, I can pick up a phone and I can get Josh on the phone.
Julie, go ahead.
How well you guys matching as far as the salary with the other companies compared to Central?
When you say other company, what do you mean?
Like,
what-
like I was talking to somebody about something, well, the school district might be paying something and you might be paying different.
I mean, we're very competitive in the market here, with the last contract negotiation that we had with a 9.5, 3.5, 3.5. I mean, we also gotta compare benefits packages and opportunities that we have that are different. You know, being a public agency, sure, are we the highest paying CDL driver organization? No, but I think we offer alternative benefits that also compete very well with our stability, you know, our insurance and other benefits that we offer outside of just salary. But I think we're very competitive in the market. We're competitive with our other even sister properties as Rochester, Albany, and Buffalo. We're in line with their pay, where we lag behind for many years, as long as I can remember. You know, Rochester is higher than us, but CDTA and us are almost within $1 of each other, a couple dollars of each other. They just got their last raise in June, so they're above us now. And then our contract raise will happen in April, which we're back in line with them. So we've done a lot of things with the partnership in conjunction with the ATU and our other union members to make our contract competitive to recruit the drivers. I think that's where we're seeing the benefits now that we're at 168 full-time.
Is this across the board? Is Oswego County having an increase as well, or are we, and is this kind of balancing?
So this is the report you have is a consolidated report. I do separate ones on them. Oswego is up a little bit. We're about 3 to 4% up.
Okay.
Currently. But it's an increase across all of our properties. Oswego's probably at the lower end. Rome is probably at the lower end too. They're about that 3-4%.
Ron probably knows this as well, that if you guys need to add winter buffers into your VIA system, they can add travel buffers that will help with the roads and conditions of the drivers so they can travel as fast. You know that.
Yes, thank you.
Thank you.
Any other questions for Josh?
And just to add a shout out for Josh and the Colobus team, I have been in Rochester, I have been in Albany, I've been in New York City.
Washington.
We're not even going. We're not even going there. I'm never going back to DC after that. We have, you know, I'm talking our sister properties. We have so much better of a paratransit system, because when I go to those places, nothing they do makes a lick of sense to me.
Thank you for that.
Thank you, Tina.
You know,
Well, go ahead.
you know, and I would like to say, sometimes even as a board member, as a person or an individual, you need to do research on your company that you are representing. And when the more research and you do with the different companies, then you become aware of how much your company is really doing and how good you are. And that's the reason why I can say, you know, for us, when I say for our we are really number one. I'm sorry, we are number one. So a lot of things that we go through is growing pains and it's learning, and we learn from our mistakes.
Yeah.
Now I've been on the board for many years, so I know, you know, we learn from our mistakes, and I completely agree. We are number one.
Well, thank you.
Because all the drivers talk to me, I must have that talking face. And they tell me all the things they complain about, and I go, we don't have that issue. We don't have that issue.
It's good to hear.
I love to say that.
That's why it is, I mean, I know we are number one and we're doing an excellent job, but now communicating. That's why it's so important that maybe once a year, we can go to the community centers and stuff like that, with the TD meeting, and explain to them, because we see it, but some of them don't see it.
Sure.
So maybe we can schedule time for them to go and
Sure.
explain to them. Because sometimes, you know, I know being a senior, some of the seniors have an idea, but they don't understand anything.
Yeah, we'll certainly add it to the outreach that we're working on and continuing to improve on. Thank you, Josh. Mr. Chairman, that concludes my report.
Okay, very good. Tina, thanks for keeping us honest on that part of it. Yeah.
As a person who's on that bus almost every day.
Okay, so Audit and Finance Committee, we just went over the financial statements that seem to be strong at this point. The other thing is, one of the biggest things is over the next month, is the advocacy and the development of the state budget to see if we can meet our goals here of what we're advocating for. I think it's important. This year could be a better year because it is an election year, so you never know. But I thought we're in a good place. So with that said, a motion was brought forward. May I have a motion to accept it? Tina, second. Anthony, any discussion? All in favor? And also, clever devices, hardware. Chris brought forward. Nice discussion. Appreciate Bruce jumping in, helping out a little bit. And awarding contract to Lion Micro LLC in the amount of $165,820 for new equipment to upgrade the clever devices hardware infrastructure work made available for. I have a motion.
So,
Anthony, second. Luella, any discussion? All in favor? Aye. And pension committee, I think one of the things that we as a board always have to worry about is making sure it's funded right for everybody. And I think with some of the decisions we made over the past years too, with funding it correctly and having some good money managers, the results seem to be higher than I think we thought they were going to be. But looking at some of the summaries there, all major asset classes finished with positive returns. International equity performance led the way, which was stagnant for like a decade. This is something that's developing, and I hope it helps a lot of the young people too, as the Fed continues cutting its interest rates. It seemed that the U.S. economy was on solid footing from the data that they received. So I think our due diligence is going well. It's going well. I think the firm is doing a good job, and I like the report outs that they do. Do I need a?
Nope.
No, just FYI.
Yep.
Okay. Any old business?
but this is not we got a TNT meeting coming up on February the 2nd at Southwest Community Center. It'll be start at 6 o'clock. What I can do, probably get some information. Nobody able to attend, I'll get some information.
Good. Let me know what you want and we'll put together a package for you.
Okay.
I also want to thank Chris for the meeting that he had with the City Utica Mayor. It was very, very productive. And they know the importance of public transportation. And that went very, very well. Anybody else? Old business, future business? We're going to head into an executive session. They have a motion regarding a personnel related meeting, and then we're going to have some board training after that. Okay, Tina, second. Neil, any discussion? All in favor?
All right.
Thank you. Okay, we just, may have a, coming out of executive session, no action was taken, we're adjourned.